Hi, it's Jacob Field here from Ripehouse Advisory. I wanted to take the time to film a video to help us unpack, to digest the recent events, the global turmoil, the things that are pushing and pulling and creating a huge amount of volatility or uncertainty in the global marketplaces, but then also the Australian property investment market. Okay, when we have this pushing and pulling, when we have these really strong, buoyant, aggressive headlines, we have a huge amount of uncertainty. We have opportunity, right? When we have this pushing and pulling, when the tree has been shaken with a huge amount of velocity, the fruit are dropping, okay? We get rotten apples, we get ripe, very juicy, strong apples. We get strong opportunities. And it's up to us to be able to have the confidence and the clarity to be able to choose those opportunities that are falling in front of us and avoid the rotten fruit. We want to be able to act with certainty and conviction, so we reach out and we grab that opportunity first, and we don't have someone jumping through and grabbing it from our grasp. So over the next few weeks, I'm going to be filming these videos quite regularly to help us unpack what is going on globally at the moment. We have Trump, we have tariffs, we have technology, we have Elon, we have AI, we have, I guess, a federal election coming up in Australia in a few weeks, not very long now, and we have all of this pressure on the economy and interest rates in Australia. What does that mean for us as Australian property investors? And before I jump into that, I'm going to tell a little, I guess it's a story. It's a conversation I had this morning. Literally, I was taking my little Labradoodle, who's sitting over here behind me, for a walk. And I bumped into an older gentleman who lives around the corner, not far away from here. And he's got his chocolate Labrador, and they're friends. Okay, so we had a conversation. And as the dogs were having their chat, we were having a conversation. And it came quickly to what is going on in Australia, but then also across the globe. What are we seeing in the markets? And he said the moment that Trump was elected, and I'm not saying that's a good thing or a bad thing, I'm not having a political conversation here, but the moment that he was elected, he liquidated all of his stock portfolio. Now, he lives in a beautiful old heritage house down here in Hobart. He'd sold a very nice big house on the water as he got older. This is a gentleman who was a technology leader 30 to 40 years ago in Australia, revolutionized the pharmaceutical chemist pharmacy industry in Australia, made a fortune, and has assumably invested it very wisely since. Okay, so this is not an insignificant amount of time. This is someone who has been around the block for decades. He's seen cycle after cycle, in his 80 or 90s now. He has seen and knows and has identified patterns that are similar to what is occurring now. So this is not a conversation or an observation that you would have or make lightly. So when you see someone acting with absolute certainty like that, we have to observe, we have to learn, and we have to see. Because when we have uncertainty, we're not liquidating stocks there the moment the election is called. We are waiting weeks, months, years. We're seeing, news articles, or we're looking and talking to others, and then we are following a herd. We're not acting with clarity and conviction. We generally get substandard or average results. When we can identify a pattern, when we can identify and relate that back to what has occurred previously, we can act with certainty, and we can turn that velocity, that push and pull, into opportunity. So that's what I wanted to talk about today, and hopefully quite regularly over the next 30 days. Would love your feedback about what you would like us to digest as Australian property investors. Jump down into the comments. Let us know what you'd like us to focus on and talk about. And please make sure to subscribe and like this channel. That's how others can also share this message, but also it helps our channel out a little bit as well. So please make sure to like and subscribe to this channel and this video. So what I'm going to be diving into today is the interest rate cliff. I'm talking about a AFR, Australian Financial Review article from today, right? It was updated today. It's talking about a news cycle a set of headlines here in Australia as of the 8th of April talking around interest rates and the likelihood, as expert economists are saying and as are quoted as saying, are going to fall off a cliff throughout the remainder of the year. And obviously, that's all news that we would love to know and hear. So it's the media playing their game of telling us what we would love to be the case. Is there actual validity in what they are saying? Is it likely to occur? Now, we have to temper this, please, because we have to understand when interest rates are being decreased, it's not usually a good sign for a wider economy. But then we also have to look at that from the perspective of where would the opportunity lie? Would it be in stocks, shares, or potentially property or other asset classes? What would be those safe haven asset classes that would benefit from interest rates decreasing? And we have to ask ourselves, when was the last time that occurred, and can we notice any patterns from that recent activity? And take action from those patterns, that pattern analysis, like the older gentleman that I bumped into on my walk this morning. How can we identify those patterns and take action the moment that we do see a pattern and not wait around for the masses to join us? So this is the article. Essentially, the news article at the moment is 29 out of 40 economists believe that we're not going to stop at one rate decrease. We're going to have many more throughout 2025. Now, is there a precedent for this? This is a chart here. It's very basic, but it's very useful in illustrating what we're looking at. We're seeing the interest rate, cash rate here in Australia, going back, until the early 90s here. I was, out of nappies at that stage, but I was still definitely in primary school. All right, we can see here when interest rates go up, the economy, we're trying to slow down inflation, right? The government is learning and evolving and getting better at doing this, but we've got a reason why we're increasing interest rates. And when they go up, they generally come down again just as quickly, if not far quicker. We can go into the GFC. Everything's running rosy. Interest rates are creeping up from 2004, even before that, right up to 2008. Guess what? Bang, GFC happens, interest rates drop very quickly. And we can fast forward that, I'll just move myself out of the way, to what has occurred since COVID. Right, we've had interest rates being increased. Okay, what the desired outcome has occurred, then we would expect interest rates to pull back once again very quickly. So don't expect this to be a once-off interest rate decrease. Expect us to rewind and remember back to 2019, 2020. The Australian economy was really sluggish. They were continuing to decrease interest rates to stimulate things, and they were really struggling to do so. We were right down there at record low interest rate levels. And then COVID occurred. Everyone realised, hang on, Australian property, we need to get involved. We had incredible property price growth. The economy got going again, and what did they do? Inflation stayed with it. Inflation accompanied the property price growth, and interest rates had to increase, and very quickly, as we can see, to curb that inflation. Inflation is back in the boundary box, okay? Global uncertainty, all of these things occurring. The economy needs to be stimulated, and quickly. It's not going to be just one interest rate decrease. And obviously, this is just my opinion. Let's look at previous precedents. It's going to be many. Right? Let's look for similar shapes. We've got here in 1996, one interest rate decrease, and then very quickly we had 1, 2, 3, 4, and then a little bit of time, and 5. We go through 2000s. We had one interest rate decrease and then a further 1, 2, 3, 4, 5. And in 2018, we had one interest rate decrease, and then very quickly things dropped through the floor. Once again, even here in 2012, one interest rate decrease, and then very quickly multiple interest rate decreases. So just my opinion, but it is also the opinion of 29 out of 40 other economists here in Australia. expect there to be multiple, if not many, interest rate decreases as we head through 2025. Let's just say, for example, we had 4. What does that mean to us today? So 4 interest rate decreases from this line in the sand. This property here in Queensland is a very, how can I say it? Middle of the road Australian high caliber investment property. It's established, it has very broad appeal, it's, good build quality in a location which is tightly held, right? This is scoring extremely highly across the Ripehouse R score right at the moment. It would be a very, probably the block size here is a little small for my, in this particular area for my preferences, but it's hitting us right square between the eyes of the core opportunity for Australian high growth residential property assets as of going into Q2 2025, right? This is it. This is what we're focusing on as property investors for growth and opportunity. It's not the $1 million mansions. It's not the cheapies out in the regionals at 100,000 or 200,000 with volatility and vacancy. It is this type of property. And as an investor, we are looking at these properties going, wow, maybe I could buy it. Maybe that would work well for us. Maybe we can even buy it in our super fund. Is it going to work for us? How is 4 interest rate decreases going to impact this property specifically? Right? We're not talking about interest rate decreases on a $4 million waterfront mansion or a $100,000, regional basket case. We are looking at the market right between the eyes, $600,000, $650,000, 3-bed, 2-bath in a really strong high growth, capital growth location. What does 4 interest rate decreases in 2025 mean to us as investors dealing with this type of core investment opportunity? Let's break down the numbers. And I'm not saying this is a buy. I've chosen this as a property that's come up on my feed today as a strong growth opportunity, but I haven't done any due diligence on it. Okay, so this is a big disclaimer. Buying costs for this, mid-market, mid-opportunity, right between the eyes of demand in Australia right at the moment, is $106,000 in buy costs. This is assuming a 10% loan, 10% deposit, 90% LVR. We've got a 5.49% yield on this property, okay? This is rents, we're talking of $34,580 per year. I can't do the maths in my head. Please do it if you can. What does that equal per week? It's around that, $600, $650, $700 a week in rent. It's a good, strong, yielding capital growth property. It can be purchased and owned by an owner-occupier. It can be purchased and owned by an investor. Like for like, you can have an older family, a younger family, a retired couple, a uni student using it as a share house, completely broad appeal. I've just chosen that property essentially at random, but I wanted to really illustrate how our investments at this level are going to be impacted by 4 further rate cuts. So here we are, we're talking interest-only loans. Okay, this is allowing us to maximize our exposure to Australian property whilst we are accumulating a portfolio. We have to understand a very clear purpose. What are we trying to achieve with this next investment and the next few? Are we in the accumulation stage? Because generally when you are in the accumulation stage of your portfolio, interest-only loans allow you to maximize and push your income into an asset base most effectively. Really important concept, interest-only loan. So all of our calculations are based on that. We've got a loan of $67,000 at 6.6% current interest rates, generates us a negative cash flow on this property. Great mid-market, high-yielding property. We've still got a negative cash flow of $7,500, give or take, per annum. That's after tax. So we're having to find, $75 a week chipping into this property to service it, to hold it into our portfolio. If we drop that interest rate down to 5.6%, 4 interest rate decreases, it might even be more, throughout the remainder of 2025, we are down to minus $1,776 per year. We're saving almost $6,000 cash flow on this property alone. So that's what it means. This is what this allows us to do. Now, if that's, and this is really important, if on a very average Australian investment property, which is broad appeal, right? We're not talking about units, we're not talking about renovate for profit, commercial. This is as broad as it gets. If you're saving, nearly $6,000 on this one asset alone, everyone else in the street is as well. And everyone else who wants to move into the area suddenly has nearly $6,000 in extra affordability per year to be able to go shopping, right? Servicing that loan, the debt that they're able to actually access to buy it increases, and everyone is increasing together. So all those people that were wanting to dip their toe into the water, all those people that were wanting to buy in the area, new jobs, new housing, unis, all of these wonderful things. We're not buying a white elephant. We're not buying something that's very niche. We're buying very broad appeal. The broader, the better. We want to increase our buying pool as large as possible. But when we do that, we have extra serviceability, but every single other person who wants to buy or live in or rent that property has it as well. And all boats are rising together and very quickly. So I'm not going to oversimplify things here, but I am, okay? When we see interest rate decreases on this core demand, affordable housing, the broad appeal, it literally transfers very quickly over to property values. Very quickly. It becomes a little bit riskier. There's a lot more variables at play at the cheapies with prospects or the million-dollar mansions, but this core broad appeal of Australia, it translates lower interest rates to increases in value extremely quickly. We saw it in COVID. I saw it in 2008. 2008. That's how old I am. I've been investing in property now for almost 25 years. It's scary. But I've seen this time and time again. When there is interest rate decreases after this prolonged period of consolidation in the Australian economy, it directly translates to very fast, strong growth in value for the right type of property. It's not rocket science. It's very simple to be able to identify these properties, but you need to have that confidence and clarity to be able to act first, know which is the rotten and which is the nice, juicy, ripe fruit, that opportunity, and be able to reach out and grab it and not let those people jump over your back and grab that fruit over the top of you, right? So we need to act with that confidence, clarity, and conviction. We would love to help and have this conversation. I'll be back tomorrow. I'll be back very soon for another conversation about this topic and how technology is coming in to help us and change us in Australian property investment. But if you'd like to chat with other people that are interested in property investment, or even dig deeper into your portfolio, what might be your next best investment property move, there's a link down there to ripehouseadvisory.com.au. Subscribe to the channel so you're first to know of my next video and when we release our next piece of content and digest what is going on together. But on that homepage there is a link to book a call, and that's booking a 15-minute discovery call to have a conversation about where you are now, where you want to get to, and how there might be a few ways that can occur. It's always a useful conversation to have. So with that, let's take that opportunity. Let's think like, the 80, 90-year-old gentleman that I bumped into and the dogs had a friendly conversation this morning. Let's think like them and act with clarity, conviction to be able to move through this volatility with confidence and grasp that opportunity with two hands and take that profit, that potential upside, and put it into our spreadsheet, into our nest egg, and create that legacy for us. So good luck out there, guys. Talk to you tomorrow.